Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to short-term loan versus long-term loans, comparing and contrasting the two options. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 617 short-term loan versus long-term loan tab in the practice problems section. Closing this back out, we're going to have our information up top. We're going to use that to go through the practice problem. We're going to start to be considering different types of loan options now. So when we have the financing, we need some type of financing. We can consider the type of financing that we might need. We're going to start to break out that financing into general categories, that being short-term financing and long-term financing as we go through our practice problems here. Now, when we think about short-term versus long-term financing, obviously that could line up with the type of loan that we might need. We'll take a look more at that in the future in terms of how would we know how much of the financing is going to be short-term versus long-term. We'll take a look at that more in future presentations, and also in terms of the risk related to short-term and long-term type of loans, meaning oftentimes when we're looking at a short-term type of loan, we could have a trade-off in that we might have a shorter interest rate or a lower interest rate for the short-term loan versus a loan that's going to be fixed in nature and more long-term, but we end up having more risk. For example, we might have, if we want to have a loan that might be for the same time period, but we have like a variable rate, and you might be dealing with this in a similar way in something like mortgage payments, where you think about a standard mortgage kind of loan where you might have a fixed loan which you tie it down for the 30 years, but the rate's going to be tied down. So whatever happens with the market, you got the rate tied down versus a variable rate loan where the loan could vary with the time, and that could have a significant effect on, of course, the charges related to the financing, which would be the interest charges. Now, when we think, there's many different ways, of course, that we can structure a loan. When you think about a loan for a car loan or you think about a loan for a mortgage, usually the focus is actually on the payments to make sure that the payments can be made. So you're breaking the payments down to monthly payments, and in order to standardize easy or similar or the same monthly payments, you're sacrificing the ease to look at basically the breakout between the interest and the principal for each payment. In other words, to have the payment the same over the life of the loan, you're making the breakout between the interest and the principal be different with each payment. So although the payment's the same, the breakout between the interest and principal will differ. And the goal of that is of course, to focus on the payment so that we can think about what we can repay, what we can fit into basically the budget and have a nice even payment structure. Now, of course, there's many different types of loans that we could be considering when we're thinking about these types of options as well. When you're thinking about a business option, we might have a business loan which would be structured in the same way, but it's a little bit more complex if a loan is structured that way to kind of compare and contrast different loan options. You can also have a loan that's going to be set up where, for example, here, we'll say that the loan is going to be the $700,000 for 2 years. We're going to pay back the entire amount after the 2 years. We want to have the whole full purchasing power of the $700,000 for that time period. Then we will be paying it back at the end of the 2 years, but we'll be paying rent on it, kind of like if we had an apartment or something or a building that we're using for our business. We would pay rent for the use of it. We're going to be paying rent on the use of this $700,000, the use of the purchasing power. That's called interest. So we're going to be paying the interest on it, and we'll pay back the interest at the end, we'll say, of each year. So we're going to be making payments at the end of each year, but only the interest portion. Then we're going to be paying back the principal portion at the end of the term of the loan at the end of 2 years. Now, if we consider it in that fashion, it's going to be easier for us to kind of compare different kind of loan financing options. And again, you might have a loan that's going to be set up for more than 2 years, or you might have a loan, say, for 2 years time period where you have a variable rate similar to the loan for a mortgage. The variable rate might give you a lower first year rate, meaning the variable rate might be lower as of now, but the bank is taking on less risk to give you that loan, because if the market changes next year in the second year, they have the ability to increase the rate along with the market. So there's a chance then the rate could increase in the second year. Or we might have some kind of fixed loan where the first year is a lower rate and the second year is going to be a higher rate. But usually those are going to be kind of the trade-offs that we'll be considering. We can either have a lockdown rate similar to a mortgage type of loan, but that'll often result in a higher rate, and then we can have some type of variable rate or a shorter term loan that we might assume that we have like a 1 year loan that we're going to have to roll over in the following year and just hope that the rate is going to be as low in the next year when we roll it over, and that of course is going to be taking on more risk. So let's consider these two scenarios where we have the fixed loan that we're going to lock down the rate over the 2 years at the 10%, and then the short-term financing, which we're going to have the interest on the first year 6%, second year 12%. If we consider that that's going to be our two scenarios, then what's going to be the difference in the interest rates? And again, the second scenario might be a situation where we're estimating that to be the case, meaning we take the 6% in the first year and maybe we're guessing, what will happen in the second year if we have to roll over the loan, or maybe we're going to take out a loan that has this kind of terms in it that will be for the 2 year term, first year 6 and the second year 12. If it's a variable loan, then we're taking on interest, we're taking on risk to see what's going to happen in the second year. Okay, so then the long-term financing option, we're going to say the loan is going to be that $700,000 that we're going to be taking out. The rate is going to be 10%. Remember, when we're talking about interest rate, we're always thinking about rates as yearly rates. Here's my giant calculator, unless they tell us otherwise. So in other words, we're going to be taking the $700,000, of course, times the 0.1 or 10%. That's going to be $70,000 for a year. So for the first year, we're going to be paying the $70,000 at the end of the year. So we're going to pay that at the end of the year. That's like paying the rent on the purchasing power as a similar fashion as we would be paying the rent on, say, an office building, just basically yearly that we're going to be paying it. We're not giving back the office building, or we're not giving back, in this case, the money, the original loan, the principal, the $700,000. We haven't given that back. We'll give it back at the end of the loan term, the maturity date, which is going to be 2 years after. Now, we have an even rate because we locked it down at 10%, so we're going to be paying $70,000 for both years. Total interest then is going to be the $140,000. On the interest charge, we're going to be paying $70,000 after the first year for interest, $70,000 after the second year, total of $140,000, and we're going to have to pay back the $700,000 original amount that we borrowed at the end of the second year. Okay, and then the second option that we might have is the short-term financing, in which we said we were going to break that out with a first year at 6%, second year 12%. So it'd be a little bit more complicated to work these out. These are great problems to work out and practice Excel to think about how you would format your table. Highly recommend doing that. We do have these problems in Excel, and so I highly recommend just plugging these into Excel and working on your formatting. So we have the loan up to $700,000 for the first year, 6%. That means that we're going to have the $42,000 on the interest for the first year that we'll have to pay back. Again, we're only going to be paying the interest, the $42,000. We're hoping that we can roll over the loan, and that might be a risk that we're taking, hoping that we can refinance the loan as needed at the end of the second year. And that might be another question as to whether we take the short-term or long-term, the question as to whether we'll need the financing for the second year. So if we need it for the second year, we might then be looking to roll it over. And then we're going to say that the rate for the second year, $700,000 loan, is now going to be at the 12%, so much higher rate on the second year. That means that we're going to be paying $84,000 on the second year. Adding those two up, that means over the life of the loan, we paid the $126,000, the $42,000, and the $84,000. We paid the $84,000 at the end of the year too, and we would have to pay back the original $700,000. The principal would have to be paid back at that point as well. So you can see in this case, then the 140 is going to be the short-term option is going to be better here. Also, you might consider in these loan options as well the time value of money. So in other words, the fact that we only have to pay back the $42,000 in the first year means that we possibly can be earning a return on the difference. Meaning we had to pay back in the first one we had to pay back $70,000. So we have a time value of money, so that difference in the payment that we have to pay on the interest might be something that we can utilize to generate revenue on as well. So there's that time value of money that you might be taking into consideration when considering the payments. If you pay the payments back later, then you get the use of the purchasing power of the money, for a longer period of time, which can be significant. So let's do this again. Let's do this basically a similar kind of scenario. We're going to say now we have the financing for $750,000. We can either say that we have a 3-year loan now. We need it for 3 years. we can take it out for 14% and lock it down over the 3-year period, which would be the more, the less risky type of thing to do, the less aggressive type of thing to do. Most people, you'll hear more conservative type of thing, but I think that word, gets confused on multiple meanings. So I'd say, I guess, less aggressive type of thing would be to lock it down. And then the short-term financing options, we're going to assume after year 1, 12%, year 2, 16%, year 3, 12%. Again, it's possible that you get a loan that basically breaks it out into this format, predicting what the rates will be in the future, or it's possible that we're going to say, hey, I'm going to take it out for the $750,000 for 1 year, take the 12% rate, which maybe is the lower rate, and then deal with the variable rate that could happen if I need to roll it over to the following year, and deal with the risk that it might go up to 16 and or down. We're going to have to deal with what will happen with the market if we don't lock down the rate. So those could be our options. And again, if we don't know what the rate is in the future, then we might make some different projections about what the rate could be. Worst case scenario, best case scenario, weigh what our risks might be, and then pick the best option based on weighing the risks and potential rewards. So we have the long-term option, once again, is going to be the loan amount of the $750,000. We're going to times that times the rate. That's a yearly rate, 14%. That means we're going to be paying at the end of year 1, $105,000 for just the interest at that 14% interest rate. And that would be for the end of year 1. We're not paying back any of the principal. That's just the interest. That's the rent on the purchasing power of the money, just like the rent would be on a building or something like that. We haven't given back the building, or in this case, we haven't given back the original principal, the original $750,000. Then, of course, we have it for 3 years. We're going to be paying that $105,000 at the end of each year, and that would give us a total of the $315,000 after we pay the $105,000 at the end of the term of the loan, at the end of maturity date of the loan, at the end of year 3. We'd also have to pay back the principal, that being the $750,000. If we then did the second option, breaking out year 1, 2, and 3 in this way, and again, this is really good practice problem to be working out in Excel. Highly recommend doing that to practice your formatting with it. We'd have to say year 1 interest would then be the loan amount, the $750,000. The rate for the first year is going to be 12%. That's the yearly rate. That means we would be paying in year 1 $90,000 interest. That's only the interest. We're not paying back the $750,000 principal. That's just the rent on the purchasing power of the money. Then in year 2, we have the $750,000 loan, possibly having to roll it over again, or possibly having a loan set up in this way, or possibly having a loan that has a flexible rate, which could add some risk to what's going to happen. So $750,000, we're going to assume the 16%. 750 times the 16% is now $120,000 for the second year. And then year 3, same process. We're going to roll it over once again. $750,000 times the 12%. Once again, that gives us the $90,000 for the third year that we're going to be paying. Then, of course, we would have to pay back at the end of the term of the loan at that original amount of the $750,000. The total interest we would be paying is the $90,000, the $120,000, and the $90,000, or the $300,000. Of these two options, if they were to work out this way, it looks like the the variable option is still beneficial here. That's just a coincidence. That will not always be the case, because again, it could be the case that the variable rate jumps up significantly higher in a second year if you have a variable rate type of term. Oftentimes you'll have a lower starting rate when you go into that type of financing option. So you might have to then kind of run different scenarios, a best case scenario and a worst case scenario. Also note, however, that you want to take into consideration maybe the time value of money, in that the first payment we had to pay back the $105,000 here, and here it's only $90,000. So once again, we don't have to pay back, the interest as early, or at least the early payment is less, which means we are holding on to that money longer. And if we're able to generate a return on our assets with it, then it could be beneficial to us in terms of just simply the time value of money.